Hello and welcome, everyone. My name is Susan Hearn, CEO of Germane Solutions, and I'll be the moderator for today's webinar, GME Financial Principles for Teaching Hospitals. This is the first webinar in our GME Financial Management series. The objectives for today's presentation are as follows. Participants should be able to understand the history and components of Medicare GME reimbursement, understand the difference between cap and count and their impact on reimbursement, discuss GME-related costs and how they're reported, and introduce recent changes to regulations related to GME finance. Before I introduce today's speakers, there's a couple of housekeeping items to share. Participants have been muted upon entry to the session. However, that doesn't always work. So if your audio is showing as unmuted, please change that to mute and eliminate the background during the presentation. We made every effort to reduce technical issues with the webinar presentation, but if you have any problems of any kind, please indicate them in a private chat to Hunter Rich on the platform. The slide presentation and the webinar broadcast are provided exclusively for the use of registrants. It should not be shared. Reproducing, distributing, or transmitting any session materials or the live presentation to any other group or individual requires express permission from Germane Solutions. If you have questions throughout the seminar, please submit them in the chat feature. We'll be answering questions as they come up, as well as during a dedicated question and answer session at the end of this webinar. If we're able to get through all the questions in the time allotted, we'll answer them live here. And if not, you have a question that you don't want to include, you have the opportunity to submit them via email afterwards. Margot Flowers and Abby Wilson will serve as chat facilitators. Every registered participant for the session will receive an email containing a link to our survey so we can obtain feedback about the webinar. The survey is brief and we encourage your comments. Now let me introduce our speakers, Jon Scaglione, Vice President of Finance, and Scott Masin, Manager of Finance, who will cover the history and basics of Medicare funding, assist you in understanding your institution's reimbursement rate, and review the associated costs of graduate medical education. Jon, also a CPA, joined Germane in 2010 and provides subject matter expertise to the complex regulatory rules governing Medicare GME reimbursement, as well as a Medicare cost report. And Scott provides extensive experience in financial projection, performance, utilizing the methods that incorporate the Medicare cost reports and Medicare GME reimbursement. Their full biographies are included in the webinar materials. Now let me turn the session over to our speakers. Jon, you may begin.
Thanks, Susan. Welcome, everybody. Today, we want to go over the basics of Medicare GME reimbursement and the impact that it has on your organization. To understand GME reimbursement, first we have to take a turn back into history to understand the rules and the regulations that govern Medicare GME reimbursement and some of the rules and regulations that govern GME. From 1996 to the Balanced Budget Act to the 2020 Consolidated Appropriations Act. As most of you may know, on December 31st, 1996, hospitals were subject to an FTE cap, which provided the maximum allowable funding for both indirect and direct graduate medical education reimbursement. That cap was set in stone. Pending some new regulations, it was very difficult for hospitals to increase their cap, and it took an act of Congress in order to do so. So if you were training residents on December 31st, 1996, that was what you were stuck with in perpetuity. However, in 2003, the Medicare Modernization Act sought to redistribute any unused Medicare GME slots for both direct and indirect medical education. The top priority for this redistribution was training in rural areas and for hospitals that had primary care need. Then in 2010, the Affordable Care Act came around and essentially had a very similar outcome, which sought to redistribute unused residency programs. 65% of any unused residency positions were transferred to hospitals that were operating well over their cap. And again, the focus there was for primary care residency training programs. As you can see, there was not much movement, no net increase in the 1996 cap. They were simply trying to redistribute any cap that was not being used by any hospitals throughout the country. But then in 2020, the Consolidated Appropriation Act came along and help to further expand GME reimbursement. Specifically, Section 126 of the Consolidated Appropriation Act distributed 1,000 new residency program slots and is currently in effect over the next 5 years, distributing 200 caps annually to eligible hospitals. Next, Section 127 of the Consolidated Appropriation Act is looking to expand rural medicine. They do so by a variety of different mechanisms, one of the biggest being the elimination of a separately accredited program for hospitals to train rural training programs. Next, and probably the biggest, is Section 131 of the Consolidated Appropriations Act, which allowed hospitals with a de minimisly low cap and/or PRA to reset those rates in order to participate in the Medicare GME funding program. With a little bit of the history out of the way, I think we need to set the table to understand how does Medicare fund hospitals for training, residency, and fellowship programs. The pie chart to the right kind of shows an example of the volume of funding for each hospital and how much each of the direct and indirect caps are worth to a hospital. First, we look at the direct graduate medical education reimbursement, or DGME. That's roughly about 1/3 of the total reimbursement that a hospital will receive. That's based primarily on the FTE cap that the hospital established in 1996, plus or minus any adjustment through the Medicare Modernization Act or the Consolidated Appropriation Act. Then Medicare seeks to pay hospitals based on their fair share of the cost for graduate medical education, and they do that primarily on Medicare utilization. So anecdotally, a hospital can expect to receive their fair share based on Medicare patients to total patients seen throughout their hospital. This is sometimes referred to as Medicare utilization or Medicare patient load. Finally, the per resident amount of allowable costs is the expense that the hospital can charge to the Medicare program for the directly identifiable expenses that the hospital incurs. Once the PRA is set, it's updated based on a consumer price index annually. So it's very important that hospitals get that right. And if they didn't in the past, that's where Section 131 of the Consolidated Appropriations Act can help. Next, we go to the largest piece of the puzzle. All right, so the indirect medical education is roughly 2/3 of the total reimbursement that a hospital will receive. And that's an add-on payment to their Medicare DRGs. So Medicare patients and managed Medicare patients get an add-on factor adjusted. And that's typically based on the resident to bed ratio. So the more residents that you have in your hospital relative to the beds in your hospital, the higher the add-on percentage will be for those DRG payments. Next, the smallest piece of the puzzle is the capital indirect medical education, or capital IME payments. Typically, it's a very small, anywhere from 5 to 10% of the total reimbursement that comes in. And again, that's based as an add-on payment to the hospital for their capital-related DRGs. So it's important that hospitals understand, well, what is our IME cap and what is our DGME cap, and then how do we effectively manage it? But before we can get to that, we have to understand, well, really, what is this cap worth to us in terms of Medicare GME reimbursement? So throughout our research efforts, we've mined all of the Medicare cost reports to understand each state and how much the average 1.0 FTE cap is for both IME and DGME. Now, as we talked about in the last slide, there are a variety of factors that impact how much Medicare GME reimbursement each hospital will receive. And it's, again, based on the Medicare patient load, resident to bed ratio, PRA, and FTE cap. On average, throughout the country, hospitals receive approximately $140,000 per resident FTE for both IME and DGME for each of the residents that they train. Now, a lot of hospitals can train over their cap. Some hospitals train under their cap. But this is the effective funding of what each hospital would have if they trained exactly at their cap. Now, we see a different spread of GME reimbursement based on this map here, and you'll notice that not all of the rates are published. We do have a table at the back of the presentation where you can look to see what your state's average GME reimbursement is. Now, you may look at this and it may seem a little counterintuitive that a state like Texas, one of the largest and most robust GME providers in the country, has one of the lowest GME reimbursements, whereas you see Montana, one of the least populated state in the country, has one of the highest Medicare GME reimbursement. Now, again, a lot of this has to do with the legacy of GME. As we said during the Balanced Budget Act in 1996, these residency cap slots were set in place and they were static. So as we see states like Montana with smaller, newer programs, they were able to set higher PRAs, develop more cap, and have more of their residents funded. Whereas a state like Texas that has legacy programs from 1996 with big academic institutions are training further over their cap. So it does vary widely, state by state, region by region, county by county. But this should give you a good understanding as far as what your reimbursement looks like relative to your state and relative to the national average. So again, we talked about the history, we talked about some of the reimbursement, we talked about the IME and the DGME, but what does this all mean? Right, the independent variable in all residency training programs are the resident FTEs. So it's important for organizations that are currently training residents to know what their cap is, how to calculate their cap, and to determine if they're over or under. Now, I did say earlier on that in 1996, the caps were static and set, plus or minus some adjustments. But there are other adjustments that hospitals can do each academic year, either through a Medicare affiliation agreement or rural designation, that will have an impact on those 1996 caps. So when we talk about cap, we talk about the maximum number of FTEs which a hospital is eligible to receive funding. That's something that each hospital should be mindful of and should definitely work with their reimbursement department to understand if there are any adjustments to those caps for anything that's being done in the current academic year. Next is the FTE count. That is how many residents are physically training within the four walls of your hospital or in any non-provider settings that the hospital can claim on their Medicare cost report. As you can see over time, sometimes a hospital will train over their cap, sometimes they will train under their cap. It's good to be mindful of where your hospital is at because we understand residents can be off cycle, there can be leave of absence, there can be visa issues that would cause a hospital to not fill all their positions, essentially leaving money on the table. But then as we've seen with the proliferation of GME, we see a lot of new residency programs starting that would put them over their cap. So again, we want to walk through how we determine the reimbursement and how we determine a hospital's example cap, which we'll look at in the next slide. So the Medicare cost report. What you're seeing here is a cutout from the Medicare cost report of Worksheet E Part A, which governs the IME reimbursement that a hospital will receive. You'll notice there's a lot of different regulatory sections and citations to the Federal Register that govern how a hospital determines their cap. This is very confusing. And what we've tried to do is we've tried to distill it down into usable information that an individual can take either to their reimbursement department or track against their Medicare cost report to determine, well, what is my cap this year? Did it change from last year? And am I operating over or under the cap? So we've taken this example and we've tried to put it into layman's terms. Now, one of the other things that we tried to do on top of putting it in layman's terms is to color code it. We reference the Balanced Budget Act, the Medicare Modernization Act, the Affordable Care Act, and the Consolidated Appropriations Act. And as you'll see, a hospital, in this case, Hospital X, had a 1996 cap of 100. Now, they started training residents in the Consolidated Appropriations Act, Section 127, so they received an increase of 3 residents. All of the other regulatory statutes that you see are blanked out, but they could have developed residents as part of a new program. They could have an addition or subtraction to their cap through Section 127 of the Consolidated Appropriations Act. They could have a reduction for unused residency slots for the Medicare Modernization Act, Section 422. Similarly, a reduction of the Affordable Care Act, Section 5506, or there could be increases to the cap for rural training programs, for Medicare GME affiliation agreements, for increases of residents from either closed or unused residency training programs, or ultimately from the award of the Consolidated Appropriations Act, Section 126. So when we look at this here, we try and add up any of the pluses and minuses that the hospital had over the years to determine, well, what are we getting paid for today and how many residents are we training? So we can see from 1996, a cap of 100, plus the 3 from the Consolidated Appropriations Act, plus another 15 from an affiliation affiliated group agreement, training residents from a closed hospital, and receiving a partial award under Section 126. So the hospital getting roughly 125 funded positions, and then they're currently training 130. So in this case, the hospital is training 5 residents over their cap, which is not a bad position to be in. But that will change year over year based on any of the following factors that we have listed. I want to go ahead and go to the next one. So again, there's a lot of numbers on the page here, but we try and distill it down into usable information so we can understand what is the relative position of the hospital. And you can see we've laid this out here with IME, cap and count, DGME, cap and count, and the amount of reimbursement per funded FTE. And then lastly, on the bottom line, the reimbursement per trained FTE. We have the similar hospital Y from their 2019 report to their 2020 report to their 2021 report. And as you'll notice here, over time, the numbers do change. That's why it's critically important for the GME office and for the GME reimbursement department to constantly be in communication to see if there are any adjustments to the cap or to the ability to count the residents that would impact the overall funding that the hospital receives. So we look at this here, we have an IME cap of 224, then it drops down, or excuse me, we're over our cap by 224 residents, then we drop down to being over our cap by 129, and then ultimately over by 164. And you may ask, well, John, you said that in 1996, the caps were static, and there were very few possibilities for a hospital to get new cap. There have since been regulations. One of the biggest is being able to be classified as a rural provider. And then when hospitals make this classification, they get a 30% increase in their IME cap only. So as you see here from their 6/30/2019 report to their 6/30/2020 report, they did elect to go from an urban hospital to a rural hospital, effectively increasing the amount of funded positions for IME by 30%. So the amount of residents over their cap has significantly decreased, but yet it's still a very high number, whereas the DGME reimbursement and cap has remained effectively about the same, being over roughly 224 to 250 residents. You can see the amount of reimbursement per funded FTE on that last shaded line, second to last shaded line, hovering around 148 to 155 over the years. But then the very last line says the reimbursement per trained FTEs. So when a hospital such as this one is operating significantly over their cap, it waters down the total reimbursement that the institution gets relative to the number of residents that they're training. So when we look at this, we want to focus on both of those two numbers, because if we were able to start new programs, we would focus on the reimbursement per funded FTE. But day to day, we want to make sure that we're managing based on a number of trained FTEs if we're operating significantly over the cap. As you can see, the numbers are pretty night and day when we're talking a difference of roughly 80 some odd thousand per trained FTE to 140 plus thousand per funded FTE. So it's critical that we get the understanding right to determine how much reimbursement is coming into the hospital and how many of the residents are funded. One of the things that we recommend that the GME office does with the finance team is get together, quarterly meetings. The clearinghouse for the two parties, the biggest thing that binds them together is the IRIS reporting, right? So understanding any changes in the IRIS reporting, any changes in the ACGME accreditation status of a program, any changes in the resident schedule, be it a new site, be it a resident that's off cycle or on leave of absence, communicating that over to the finance team will help them understand how many FTEs are ultimately going to go on the cost report for the period ending to determine how much reimbursement is ultimately going to be remitted back into the hospital. So it's absolutely critical that you work together hand in hand with the GME office and the GME finance team to understand how much is available in terms of IME, DGME cap, and total Medicare GME reimbursement.
All right. Are there any questions on the reimbursement side of things? I haven't seen too many come through the chat, but feel free to add those in, and we'll definitely have some time to answer those either now before we shift to looking at costs, or we'll definitely be able to get to those at the end. But feel free to add any questions into the chat as we move through the remainder of the presentation. All right, well, now that Jon has gone through and talked about a lot of the different reimbursement aspects of graduate medical education, now we're going to jump into the cost side of things. So when we talk to our different clients, or we talk to different institutions across the country, we've really determined that there's a black box of graduate medical education costs, and it all depends on how these different institutions are claiming these costs. And we have a couple examples up here. Well, if we're looking at the institutional level, we could have the DIO, we could have the director, we could have the institutional coordinator. If we're looking at the program itself, it could be related to the program directors, the core faculty members, some of the subspecialty education coordinators, some of the space related to it. If we have a continuity clinic, how much of that cost really sits on the graduate medical education books versus just the clinical operating expenses of the hospital. So we do have recommendations as far as what we think is the true cost of graduate medical education, because it can really be split by so many different areas, whether it's in the department that the specialty is based in, whether it's in the GME office, the proper GME office, or it's sitting in a physician group or another clinic outside of the hospital. To further back up some of this information in this black box that we're speaking of, we pulled all of the information across the country related to what the costs are reported for graduate medical education related to training. So you can see in the first box here, these are the programmatic costs. So this specific bucket, it just includes the resident salary and fringe benefit rates. We took the total costs and broke it down for each institution on a per resident basis. I don't know many residents across the country that are only getting paid $20 per year, but this just shows the variability in what's actually being reported. The max is $3.6 million in cost per resident, and the average is around $29,000. For the overhead costs, so this is the administrative in general. If anyone on the call is familiar with the step down as part of the Medicare cost report, these are all the different overheads related to the hospital and the operations to keep the program going. Similarly, the minimum that we found was $20, maximum is $1.1 million, and the average is around $9,000. So when we look at the GME costs across the country, the average total cost is $38,000 per resident. We all know on this call that that is not possible, because just the resident salary and fringe benefits alone is much, much higher than this. But this just goes back to a lot of these costs are hidden in different departments or clinics or anywhere else across the board. And we really think it's important to be able to track down and see exactly what the costs are on a per resident basis, so you can evaluate things across the board. So the three different areas that we find that are very important to kind of bucket these costs are the three ones listed below. So first we have direct program costs, and then direct resident costs and institutional costs. Within direct program costs, this is what you're familiar to as far as program leadership. The program directors, the associate program director, if that's applicable, core faculty, any subspecialty education coordinators, or some of these clinical rotations that are outside of some of the individuals that already have protected time. And what's different than what we see at a lot of institutions is how we model these costs. It's specifically related to the costs that are non-clinical or graduate medical education specific. For example, if we have a program director that needs to be 60% administrative, the remainder of that time, we would expect them to be clinically active. If they have residents with them, they're still seeing patients and generating revenue on the patient care side of things. So for those different program leadership positions, we take that administrative cost, we load that in here, but the remainder kind of still sits on the department or where they're providing services, because they are still generating revenue. For the direct resident costs, around $80,000 to $90,000 per resident. This mostly is made up of the resident stipend and fringe benefits. We would expect the resident salaries to be anywhere from $60,000 to $75,000, depending upon what PGY level or geographic area they're in. But for the most part, that is what makes up this. In addition to that, there's some additional resident benefits, recruiting, allowances, those different items. Finally, the institutional costs. This really varies a lot from institution to institution. If we only have one institution, if we have an institution with only one program, their institutional costs in totality are going to be a whole lot lower than an institution with 90 programs and 1,000 residents. So this is what we normally like to do with this one is we take the full costs and then we allocate it back to the respective programs on a per resident basis. But these costs really include the DIO, an institutional coordinator, if you have a director of graduate medical education or a manager, that's where these costs sit, and then they get allocated back to the programs. And then specifically for space, just want to make sure that this is clear. This is not including if we're going to do a large capital build out or something like that. This is really just the space related to keeping the lights on and some of the overhead expenses related to the space, specifically in the GME office or the residency lounges, those types of areas. This is not including the depreciation of those new types of clinics or the residency space. On the next slide here, we're trying to break it down into a little bit more detail and actually putting some numbers to what we were talking about previously. For the direct program costs, you can see here just acquainting you with the table on the right side of the page. You can see there's 5 different programs outlined here. The program sizes vary from 6 residents all the way up to 36. The different costs for each one of these positions. This is variable depending upon the program specialty and depending upon the program size. So this can very much change. As you're all very familiar with, it's not a one size fits all for the program requirements. They vary for each and every program, and we want to make sure that these cost projections are dependent upon what the ACGME is looking for that specialty and for that size of program. In addition to the program director, core faculty, we also have the program coordinators and then the fringe benefits related with those different salaries. So you can see the subtotals here for the different programs are very different for each one. For the direct resident costs, as I mentioned before, the lion's share of these costs are really related to the resident stipend and fringe benefits. In addition, we have some malpractice expenses, recruiting costs, and then other just direct costs related to operating these residency programs. Then finally, institutional costs, the DIO, the administrative director, all those different items that I spoke about previously. We can see in the total program costs row, the cost of these programs is variable significantly from program to program. The step that we like to take it one step further that we like to take it is that we like to look at it on a per resident basis. So we can see internal medicine versus cardiology, it's almost double the price on a per resident basis. But if we look at the total cost of the program, internal medicine is significantly more, over 3 times as much expensive. So this is the step that we'd like to take to say, okay, if we want to look at this internal medicine or cardiology program, which one makes the most sense? And if we're looking at, as Jon talked about earlier, our average reimbursement across the country is $140,000. What value are these different programs bringing to the table related to just the cost and the reimbursement? And then on the next slide here, we'll go into a little bit more detail on some of the non-financial benefits that we're all very much familiar with that these residency programs and fellowships bring to the table at their respective institutions. So these are the 5 that we normally like to cover. Obviously, there's a lot more that the residents and fellows bring to the table, but these are the 5 main ones that we like to cover. For recruitment, this is probably the top benefit that we talk about and that clients bring to our attention. But there's really a great opportunity to create a pipeline of physicians that stay in the communities that they ultimately train in. Across the country, the retention rate is around 50% of where the residents train. They stay in that state. It'd be a little bit different for that exact community, but specifically in that state. And if they do their training and graduate medical education and go to medical school in that same state, that increases by almost 20%, close to 70%. So a lot of physicians or a lot of health systems are very interested in starting these programs to have that pipeline of physicians to address their growing shortage and to address the aging physician population. The one other piece that will lead into this a little bit more in the future is that different states now are really focusing on this item as well, because they're starting to give different financial compensation for starting these programs to offset the costs, because they know that there's a higher likelihood of having those physicians retained in their respective states. For quality in graduate medical education training, and we can definitely get you the studies for the retention rates from the AAMC. And for the quality, for these specific programs, quality is something that's intertwined with graduate medical education so closely, whether it's their integration into the quality committees, or whether that's part of the research and integrating in evidence-based practice for their training. This is something that really goes hand in hand. Furthermore, we see the U.S. News and World Report year in and year out. The top hospitals on those lists have to do with very high caliber residency training programs. And one of even the common misconceptions is that hospitals have to have graduate medical education training programs to be part of those lists. But that's really not the case. It just happens to be it's more of a happenstance that the hospitals with a lot of training programs are top on these lists. For coverage, if these residency programs are run properly, this shouldn't be the main reason for starting the graduate medical education programs, but they definitely provide a lot of value to the hospitals and provide that coverage in the specific areas where they're practicing. Depending upon the different sizes of those programs of residencies and fellowships, varying levels of coverage is provided, but nonetheless, additional patient throughput can be provided by these residency programs. For the complexity of care that's available with the residents and fellows being integrated into the health systems, the requirement of residencies rotating through different subspecialty areas and also fellowships and what they need to do to get their training completed, we see this hand in hand with graduate medical education programs where the complexity of care is elevated with the residents and fellows that are pushing the envelope, asking questions, and keeping the physicians on their toes related to providing care for those patients. So this is something that we see as a very high benefit to hospitals and health systems for graduate medical education. And finally, for productivity, there is a benefit to having these residents in increasing the productivity in different areas in the hospital. This is not something that is normally observed within the first year of a new program, or even the second year of a new program. It's normally once the program is at full complement in a well-oiled machine, then you start to see some of these different benefits. And largely, a lot of those benefits that we see is more in the outpatient setting. That's where we see it the most often. But the one caveat is here, we need to make sure that the programs and the physicians are properly leveraged in order to see more patients than they would just see by themselves individually. So specifically moving to industry movement, one of the questions we get pretty frequently from our clients is that if we start these programs today, what is the likelihood that these funding mechanisms will stay around for the future? Can you guarantee that? What's been the industry movement related to graduate medical education? One thing that we can say confidently is that we can't guarantee things are going to stay exactly the way they are today, but we have really seen a lot of support across the board from the state, from the federal, from even private institutions related to graduate medical education. And this comes back to some of the statistics I was talking about earlier related to resident retention back to the states where they're training. And so a lot of different parties are investing their money into this because they know that they'll have a good return on their investment and hopefully retain those residents to their areas. Some of the specific examples we wanted to go through on this are the 5 we have listed on the screen here. So the first one is the Consolidated Appropriations Act. This is the one that John was talking about earlier, related to Section 121, 126, 127, and 131. And it really just opens up opportunities for previously capped hospitals to create new residency programs, for more flexibility in getting residency programs started in rural areas, and also for previously capped hospitals to reset their caps. So a lot of opportunity there across the board, and very much see that as one of the examples that on the federal level, they're really trying to increase the opportunities for funding for graduate medical education. Affiliation agreements. These are opportunities, and not to be confused with master affiliation agreements or affiliations between medical schools and hospitals. But this is an opportunity that between two hospitals, you can share cap to hopefully increase or utilize reimbursement for the training of residents. These affiliation agreements, the flexibility for those and the wording behind these, there's additional opportunities for them to utilize this to maximize the reimbursement for the residents at the end of the day. Rural designation, as John talked about previously, this is something where when we say rural, it doesn't have to mean that you're sitting out in a rural part of the country. Hospitals all across the country have taken advantage of this, whether it's in New York City, whether it's in Los Angeles, or whether it's in Miami, Florida. A lot of hospitals have taken advantage of this to create new funding cap for previously capped hospitals. So as John said before, there's a 30% increase on your existing cap, and you create new cap for any newly accredited program. And with some of the recent changes, it makes it even more available to more hospitals because there's not as large of a financial hit up front. So definitely opening the door for a lot more graduate medical education development across the country. State funding, historically, many years ago, there were very few states that provided graduate medical education funding for residency programs. Now, more and more states are starting these different funding mechanisms. And it's not just one funding mechanism. It's a startup bonus. It's a primary care incentive. It's a Medicaid funding mechanism. A lot of different elements are starting to open up because the states are seeing the benefits of investing money into graduate medical education training. And finally, for the IPPS rules, the ones that are coming out in August, there's additional benefits related to Section 5506. If anyone is familiar on this call, when hospitals close, they reallocate that cap. And there's a couple hospitals that are listed on that, and a significant amount of cap that could be gone after for hospitals that are currently training over their cap. Furthermore, as I mentioned, for rural designation, these rules make it even more advantageous for these hospitals to start new programs with less of a financial hit. So all in all, really great opportunities for graduate medical education, and we only expect more of these opportunities to continue to come available and help to grow graduate medical education across the country.
Thanks, Scott. With that, that concludes the primary focus of today's webinar. We do have 2 additional webinars planned, one for new teaching hospitals. So if your organization is getting ready to start graduate medical education programs, or you're within the first 6 years of starting a residency training program where you've never had one before, we'll go through the basics of how to count a resident, how to put it on the cost report, how to get funding for these residents, and really what to look out for. So that one's geared more towards new teaching hospitals that need to understand the basics of that transition time from a community hospital to an academic hospital. And then the final presentation we have planned is for industry movement. Those last 5 bullet points that Scott went into, we'll go into in greater detail. We'll be able to show some of the benefits of rural designation and a few examples. We'll talk about the affiliation agreement and the proliferation of GME slots throughout the country and what we see as the industry moving forward. We recognize that bringing a new doctor to market has to pass through the bottleneck of graduate medical education. So we have to get those medical students from graduation all the way out to board certification. So The federal government and state governments are really trying to emphasize this to make it a little bit easier in order to do so. So with that, we conclude our webinar.
Thank you, John. Thank you, Scott. We'll now open the floor for questions from the audiences. So if you do have a question, please type it in the Q&A box. There were a few that have come in already, and one was related to average recruitment cost per resident. And do we have that on a state-by-state basis?
Yeah, I would say it's not on a state-by-state basis. As you can see, based on the GME reimbursement, it really comes down to resources, right? It's how much are you willing to spend on recruiting residents into your market? Really, it's the same thing as recruiting doctors into your market. We see as low as a couple $100 per resident, especially if you're in a big metro area where you've got a lot of medical schools. You can typically drive down those costs, especially after COVID. There's a little bit more of an emphasis on, WebEx and things like that. But more rural communities, we do see it can be several $1,000s to fly them out, get them in the community, put them up. So when we work with our clients starting new residency training programs, we really want to bake that into the cake to make sure that they understand each year, what is it going to cost to get qualified candidates to come to the market?
And one other related is, does that apply to New York City? So you mentioned bigger cities, but do we have any information specific to New York or other really large cities?
Yeah. Again, it does depend on the institution. There are a lot of institutions that get, well below the $140,000 of IME and DGME reimbursement. So if they really can't afford that, they have to dip into the hospital's pockets to be able to pay for those things. So there's not a national average for recruitment cost of residents. But again, we view a residency program as really a trial run for employment. So making sure that they feel welcome, making sure that they feel like this is a place that they want to come and practice in. We feel that those are very good investments into the program.
Thank you. And when we talk about the average reimbursement being $140,000, is that inclusive of DGME and IME?
Yes, that's correct. That would be for both the direct and indirect portions of the GME reimbursement.
There's also a question regarding children's hospital data. Do you want to really kind of reference the differences in that reimbursement?
Yeah, because Medicare is the primary funder for graduate medical education, and they pay for their fair share of the costs of a residency training program. We know that children's hospitals obviously have little to no Medicare patient volumes. So they're separately funded through HRSA. There's an annual grant of roughly $300 or $330 million that freestanding children's hospitals can apply for each year to draw down some of that grant funding.
And then does reimbursement go through the sponsoring institution or through the hospital?
Good question. So the hospital is the clearinghouse for all of the federal payments. So it's tied to a Medicare provider number, and it's very similar to your individual taxes, where the federal government will pay the hospital throughout the year, either on installments monthly for the direct component, or as we talked about earlier, as an add-on to each one of the DRGs when a patient is discharged. So those payments will go directly into the hospital, and then they'll be settled up on a Medicare cost report similar to your tax return. So either the program is owed money or they have to remit money back into the CMS coffers.
And one other one, shifting a little bit. And when we look at fellows, since fellows are beyond their initial residency period, do they get 50% of the reimbursement that residents get, or how does that work?
Yeah, for fellows, once they've eclipsed their initial residency period, the federal government feels that they've paid most of their fair share for the cost of that training. However, they will be paid 100% of their IME rate, which is roughly 2/3 of the total funding, but they will be weighted as a 0.5 or 50% for the DGME reimbursement. So they will get less reimbursement, but they will still get that key IME reimbursement paid at 100%. It's just 50% for the DGME.
Thank you. Any final questions? We have about 2 more minutes if anyone has anything else. Okay. Well, thank you to our presenters for the information and the insights provided today. In wrapping up our session, we want to thank all of you for participating. As noted earlier, you'll receive an email this afternoon with a short survey to complete, as well as a copy of the presentation. If you have any outstanding questions after today's presentation, please email Ian Sullivan. His email is here on this page, but isullivan@germane-solutions.com. And for additional GME content, we'll also be hosting the GME Financial Principles that Jon had mentioned earlier. Upcoming details and registration information for this webinar will be found on LinkedIn and also on our website. Since this is a series, our marketing team will ensure that every participant in the webinar will receive an email containing the sign-up link for the upcoming webinar. To be included in important future announcements, follow Germane Solutions on LinkedIn or contact us on our website. Thank you again for your participation in today's webinar.